The way we frame development, it's very much part of that security doctrine in the sense that it is preemptive security. We invest in markets that are sometimes considered uninvestable. By investing in these markets, 65 markets across the world, former Commonwealth countries of the United Kingdom, we're creating opportunities for UK firms. I think as regulatory environments improve, as we make these markets more investable, the potential to create larger inflows of foreign direct investment to flow into these markets are extremely high. So you want countries to go up this sort of economic ladder and to become developed economies where we are no longer needed.
Development finance has a problem. Soaring costs on debt and defense mean that governments in the West have less resources available for overseas development assistance. Development finance institutions are now making a virtue out of necessity. They are moving from a developmental approach to a more commercial model. British International Investment is no exception, and its CEO, Leslie Maasdorp, is with us today. Sir, thank you for joining us.
Thanks for having me.
Let's start from ODA. What do you think is the role of overseas development assistance in this day and age of geopolitical fragmentation and fiscal imbalances?
I think it's important, Jacopo, to start with what role it has played in the past. I mean, as you know, the current formulation of overseas development assistance is at least 53, 54 years old. In the early 70s, literally 1971, the G7 countries adopted a principle of devoting 0.7% of gross national income to the developing world. And that was kind of seen at the time as both pragmatic, as sort of achievable. It is not too excessive. You know, that the rich countries were willing to invest in emerging markets as part of a longer-term strategy of, I guess, seeing it in its own long-term self-interest, right? Development elsewhere in the rest of the world is linked to domestic security, to domestic prosperity. You cannot, in your borders right next door, your countries have instability or extremism or illicit finance and so on. You'll have, migration flows, and you'll have all range of challenges. So there was a conceptual logic that informed overseas development assistance. The world has changed fundamentally today. One, because of fiscal constraints. Most of the development world have significant sort of domestic fiscal pressures. And then secondly, as you've referenced, the need for national security, investing in defense, is preeminent, right? So that security doctrine is central to the world today. The way we frame development, it's very much part of that security doctrine in the sense that it is preemptive security. We invest in markets that are sometimes considered uninvestable, and we provide we make these markets investable in the form of creating markets, being the first to invest there, which then kind of de-risk those markets. So you create the market infrastructure that can take those countries on a path of economic development. That is still required, but there's a different paradigm within which it's now situated.
So what would you say is the ultimate goal of development finance? There was, up until a few years ago, there was an idea, an ambition maybe, of using tools like development finance in the emerging world to trigger reforms towards a more liberal markets and liberal democracy, even frameworks. Is that ambition still there, or does it boil down to what you're referring to, securing the neighborhood or securing your partner countries?
From a BII perspective, the development finance world very much believe in the private sector as the lever through which we can effect change. And we look at it very much as us playing a complementary role. We're not directing the traffic or sort of imposing models or what we believe is appropriate for Egypt or for Sierra Leone. We will play a complementary role in providing capital and often also technical assistance to ensure that these companies can grow and thrive.
But what is your ultimate ambition?
The ultimate ambition, I would say, would be like a South Korea, which was a very poor country 50 years ago, and today it is top 10 GDP per capita, and it's a net donor today. So you want countries to go up this sort of economic ladder and to become developed economies where we are no longer needed.
And how does this serve, in a nutshell, the UK's foreign policy interests?
As I mentioned, the DFI was, BII was created by the UK government way back in 1948. So it's the oldest development finance institution. By investing in these markets, 65 markets across the world, former Commonwealth countries of the United Kingdom, we're creating opportunities for UK firms. Give you an example, we invested alongside Vodafone in Safaricom, the second mobile operator in Ethiopia. There's 110 million people there. So that company is growing, providing an economic opportunity for a British company to grow and thrive. So we're also creating markets for domestic US, and in that sense, we're contributing to growth in the United Kingdom.
Leslie, I mentioned in my introduction, DFIs are moving from a pure developmental approach to a more commercial model. How is this shift impacting BI? You have just launched a new 5-year strategy. How are you trying to take on a more commercial model without compromising on your ambitions?
So when BI was started and to this day, we look at the world through two lenses. One, we need to make a commercial return on the investments that we make, but at the same time, we want to see development impact. And we measure that development impact in a very sort of deliberate manner. So what is the shift? The shift is essentially moving from us deploying capital, investing in a single transaction, for example, and assessing what impact that transaction is having. That's the kind of the old model. We're now moving a model where we want to play more catalytic role. We want to look at an investment through the lens of how can we de-risk the investment, improve the risk return profile, and in such a manner that we can make it more attractive for your commercial capital to step in. So you need to design structures, you need to come up with blended finance structures, for example, where we could, for example, take the first loss and create the conditions for others to enter. And there's several examples I can make of how we've done that successfully. But in a nutshell, the entire industry, not just BII, International Finance Corporation, Africa Development Bank, European Bank for Reconstruction and Development, all the development finance institutions have recognized that public resources are too limited. If you look at the total available, if you add up the balance sheets of all the development finance institutions, all the multilateral banks, it's still a fraction of what is needed in terms of the development or the financing gap. There is, as you might know, something in the order of $120 trillion that sit in pension funds, in insurance capital, in sovereign wealth funds. If we can even mobilize between 5 and 8% of those resources, and it is very doable, if we can deal with some of the structural barriers. For example, these institutions do not want to invest in small transactions in individual countries. They don't have the ability to do all this due diligences and the complexity. So we need to create the necessary structures to crowd in more commercial capital.
And one unique feature of BAI so far is the fact that almost 70% up until 2024, 70% of your portfolio of investments was equity investment, which is a remarkably high figure, even for a development finance institution. How is this paradigm shift going to affect that composition? Should we expect a bigger loan book?
Investing in equity is vital for capital formation. We cannot, as development finance institutions, only provide debt. Remember, these markets are at early stages and quite rudimentary, so equity plays a vital role to then attract other equity providers, to then attract debt, to then take those private companies to public markets and to create secondary market exits. So this is all about market development and creating an ecosystem for private sector companies to grow. Going forward, we will continue to invest in equity because it's a vitally necessary part of the capital stack in these markets. However, it is necessary for us now to invest in these markets through a different lens. We will now look at local capital pools. So let's take Africa. It is still difficult to attract large pension funds to go into, let's say, Sierra Leone or Zambia or Ethiopia. So what we will now do in future is to try and attract more domestic sources and use our structures, whether it be equity, debt, or funds, to achieve that.
So would you expect this composition to change between the debt?
So
and,
it was predominantly equity dominated in the past. At the moment, we have roughly an approach which is about a third in equity, a third in debt, and a third also in funds. Funds enable you to have a more diversified approach because funds, as you know, have other LPs as well, have other investors, so you're able to have much more broader impact. So we will continue with the approach to invest in equity, specifically in markets where we know if we don't invest, others will not enter.
And you still, in your strategy, have a strong focus on a frontier market. You want to deploy 25% of your capital in so-called frontier markets.
Absolutely. Kind of inferred in your earlier question is this notion that as we move towards mobilizing private sector capital, it could lead to us shifting towards more stable, more middle income countries with middle income features, because that's where commercial capital will be more willing to go. So let's take Africa. They'll be more willing to invest in Egypt or South Africa or Kenya, or in Asia they'll be more keen to invest in Philippines or Indonesia and so Vietnam and so on. We need to make sure that we continue to invest in the hardest to reach markets and the riskier frontier markets, as we call them. So we have allocated in our new 5-year strategy that a minimum of 25% of our capital will continue to go into these frontier markets, because we also have another objective in our 5-year strategy, which talks about market creation or market level impact. We don't just invest, as I referenced earlier on, in individual companies. We want to make sure that we create markets so that others can enter. And by building the ecosystem, you can have a much more magnified impact.
What would you say are the biggest problems that you're trying to solve in emerging markets at the moment?
I'd say the single biggest challenge that we find in Africa, which is obviously different from Asia, because a number of the markets in Asia are structurally more developed. But in Africa, I would say one of the key challenges we have are in your frontier markets, because the conditions are still so adverse for commercial players to enter. So investing in those markets is heavy lift, right? Because often you don't have the policy in place. If you want to do a solar, let's say there's good renewable energy resources, you want to generate the solar industry, right? In order to do that, you need an enabling policy environment, and often that environment does not exist. Secondly, you also, because you don't have track record, it's difficult to even bring other investors in with you. So we often have to take early stage risk.
Another distinctive feature of the geographies you are active in, mostly in Africa and South and East, Southeast Asia, is the fact that these geographies have a positive demography, unlike most of the rest of the world, I guess. Does this affect in any way your investment strategy and makes it different than an investment strategy of DFI that has also interest in other parts of the world?
Oh, absolutely. I mean, I'd say that the single biggest sort of driver of optimism that I see every day, and I have the opportunity to visit a lot of our investee companies, is just the rich entrepreneurial talent that you sort of feel when you enter these markets, right? So we have, as BII, already for decades invested in entrepreneurs through the venture capital market. We've almost created the industry, actually, the private equity industry, the venture capital market. So first time funds that were established with our track record, we back those entrepreneurs to build and expand, and we've almost created the ecosystem for these venture capital funds to flourish. So the demographic dividend, you are spot on, is the single biggest driver of economic growth and opportunity in these markets. So these are new consumers. A lot of them are digitally natives, meaning that they understand the digital economy. They have mobile phones. They are the future consumers. So that aspect is probably the single biggest driver of the positive economic story of the African continent, as well as Asia.
You come from an experience at the New Development Bank, the Development Bank of BRICS countries. There is a sense that Western countries are more reluctant, have been more reluctant. Western investors have been reluctant in investing in places, continents like Africa, unlike investors from the developing world, which are increasing their exposure to other developing countries, this kind of like south to south connection. So now you are on the Western side of the story with BII. So what has yet to happen for investors from Europe, the US, from the Western world to take a leap of faith or be more exposed to African countries and the African story?
Look, I mean, I think the African growth story is very clear. Firstly, you're going to have, 2.5 billion Africans by 2050. 1 in 4 people in the workforce will be from Africa in the next 20 years. So Africa has this massive demographic dividend. These are future consumers. So whether you are Apple or Google, any financial services company, these are the consumers. It's your future market, right? I think as regulatory environments improve, as we make these markets more investable, the potential to create larger inflows of foreign direct investment to flow into these markets are extremely high. You already have huge success stories, right? I mean, there are many countries on the continent, in Kenya and Egypt, in Nigeria, South Africa, where you've got significant global companies that have invested in those markets. They might be a little bit more reluctant and resistant to invest in, Burundi or Sierra Leone and so on. But there are already, huge demonstration of success in many of the middle-income countries in Africa.
Leslie Maasdorp, CEO of British International Investment, thank you very much for being with us today.
Thank you for having me.
Thank you everyone for watching. You can follow all our coverage on our website, fdiintelligence.com, or on our YouTube channel. Until the next time.